Welcome to the deep dive. We're here to sort of cut through the noise and really get to the heart of what's driving things. And today, wow, we're jumping right into the data flood. It's everywhere, this ocean of information.
It really is. And it's growing exponentially.
Especially with AI, right? That ocean's becoming more like a tsunami.
Uh-huh. Tidal wave.
So managing it, storing it, making sure it's ready for those, hungry AI models, that's a massive challenge. Maybe the challenge now for companies, how do they even keep up?
It's a huge question.
Which brings us to today's focus, Pure Storage, stock ticker PSTG.
Mm-hmm.
They seem to be at this really critical point, of a very opportune moment in this whole AI data thing.
Exactly. And that's our mission for this deep dive. We want to really understand how Pure Storage is setting itself up to be, well, a primary beneficiary of these huge trends. We're talking AI spreading everywhere and also enterprises moving to multi-cloud setups. It's big.
Not just another company story.
No, it's more like a blueprint. It shows how the economy's rewiring for AI, super relevant for, anyone trying to figure out this tech shift. We'll look at how they went from being maybe a niche hardware player, high performance, yes, but still niche, to now being seen as the strategic platform, delivering storage as a service, or STaaS, mission-critical stuff, energy efficient, too.
And the market's definitely paying attention. Those Q2 numbers, the fiscal 26 ones they just reported, August 27th, they tell a story.
They certainly do.
Total revenue hit $861 million. That's up 13% year over year. Pretty solid. And comfortably beat what Wall Street was expecting.
Right.
And their non-GAAP EPS, earnings per share, adjusted, came in at 0.43 cents. Also ahead of forecasts. Strong numbers, clearly. But how much of that is really down to the AI boom we mentioned?
That's the million-dollar question, isn't it? Or maybe $1 billion now. And what's interesting is it wasn't just a small beat. It was significant, both top-line revenue and bottom-line earnings, which gave management the confidence, to raise their forecast for the whole year. They're now looking at $3.60 to $3.63 billion in revenue.
And that's a confident move.
It is. And it signals something bigger. It suggests this isn't just a one-off good quarter. It feels like the start of maybe a sustained growth cycle. And you're already seeing it move the stock, reinforcing that bullish feeling investors have. They see a real shift happening, partly fueled by AI demand, giving the business a nice tailwind.
A real tailwind. Okay, that makes sense. And it leads us right into something I find really interesting, how they're changing their revenue mix. This big push towards subscriptions. Now, some might say, okay, subscriptions just change when you book the revenue. But you're saying it's more fundamental than that. Why is it so critical?
Oh, absolutely critical, because it fundamentally changes the quality and predictability of the revenue. I mean, look, historically, they've grown consistently. Fiscal 19, they were at $1.36 billion. By fiscal 25, they hit $3.17 billion. Good top-line growth.
Yes, steady climb.
But let's say, the more profound story is this shift to subscriptions. In fiscal 24, subscription revenue was $1.2 billion. That was up a hefty 26% year over year.
26%, wow.
And it kept going. Q2 fiscal 26, subscription revenue grew 15% year over year. It's about building a business that's, more predictable, more resilient.
So for listeners, it's not just, hey, the numbers are bigger.
Yeah.
It's about that foundation becoming stronger, more stable. How does that predictable income really change things for a company like Pure, make it more attractive?
You've nailed it. It's like trading the roller coaster of traditional hardware sales, big deals, then maybe a quiet quarter.
Right, the lumpiness.
Exactly. Trading that for the smoother ride of a software company's recurring revenue. It just takes a lot of the risk out of the future. And the numbers we use to look ahead, they back this up. Things like subscription annual recurring revenue, ARR, and remaining performance obligations, RPO.
RPO. Remind us what that is again.
Sure. RPO is basically all the money they're contracted to receive in the future for subscriptions and services, but haven't booked as revenue yet. It's like a backlog of guaranteed future income.
Got it. A good forward indicator.
A very good one. So end of fiscal 24, subscription ARR hit $1.4 billion, up 25% year over year. And RPO grew even faster, 31% year over year, reaching $2.3 billion.
31% growth in future contracted revenue. That's strong.
Very strong. And it stayed strong. Q2 fiscal 26 RPO was up 22% year over year. So, stepping back, when you see these subscription metrics consistently growing faster than the overall business, it tells you the quality of the business itself is improving. It makes the future growth path seem, well, less risky. And that's why the market starts valuing them more like a software platform, less like just a hardware box seller.
Okay, that shift in perception makes a lot of sense. And it brings us to another really impressive part of their story, the journey from, being this fast-growing innovator but burning cash,
Uh-huh. Typical startup phase.
to now being profitable, mature, generating serious cash. How did they pull off that turnaround? What enabled that inflection point?
Well, a big part of it goes back to their core tech and how they manage costs. They've always had really good, best-in-class gross margins. In fiscal 24, their non-GAAP gross margin was 73.2%. That's high.
73%. How do they manage that?
It's largely down to their software-defined architecture. It lets them squeeze more performance and value out of standard NAND flash memory chips compared to competitors. More efficient.
So software is the secret sauce even for the margin.
Fundamentally, yes. And that strong gross margin gives them the room downstairs, to achieve operating profitability.
Yeah, and we've definitely seen that happen. The operating income turnaround is pretty stark. You look back at fiscal 21, they had a GAAP operating loss of over $230 million.
Right, burning cash.
Then, fiscal 24, they flipped to a GAAP operating profit of $53.6 million. Okay, only a 1.9% margin on a GAAP basis, but still a huge swing. But then you look at the non-GAAP number for Q2 fiscal 26, 20.1% operating margin. That really shows the leverage kicking in, right? Scale benefits.
Exactly. That 20.1% non-GAAP margin is proof of operating leverage. As revenue grows, the profits grow even faster because many costs don't scale up at the same rate. And this flows right down to the bottom line. Net income went from a loss of about $143 million in fiscal 22 to a profit of over $106 million in fiscal 24.
Wow.
Same story with earnings per share. Went from negative 50 cents in fiscal 22 to positive 31 cents in fiscal 24. It's a clear, sustained move into profitability.
It really feels like they've hit that sweet spot. The investments are paying off.
It does seem that way. The model is working, generating consistent profits now.
And all this is built on a really solid financial foundation. Their balance sheet looks incredibly strong, like a fortress.
That's a good way to put it.
They have something like $1.5 to $1.6 billion in cash and equivalents. And against that, total debt is tiny, around $100 million.
Very little leverage, lots of cushion.
Plus, they're generating a ton of cash flow. Over the last year, about $566 million in free cash flow. And they're giving some back to shareholders, too.
Right, the share buybacks, $135.7 million in fiscal 24, and they authorized another $250 million.
That definitely signals confidence from management about the future.
It does. A healthy company returning capital.
Okay, let's pivot now. We have to talk about AI. It's everywhere, this huge, maybe generational driver of demand. Lots of companies are saying we benefit from AI. But what makes Pure Storage different? What's unique about their position? Why aren't they just another company riding the wave?
That is the crucial question, because you're right, not all storage is helpful for AI in the same way. The key thing to understand is why Pure's tech matters for AI. These modern AI models, particularly when they're learning, training, they need to swallow enormous data sets.
Right, massive amounts of data.
And they need it with incredibly low latency, super fast access. Why? To keep those very expensive power-guzzling GPUs busy.
The GPUs. Can't have them waiting around.
Exactly. If the storage can't feed data fast enough, the GPUs sit idle. It creates a bottleneck. It's like having a Formula One car stuck in city traffic. Hugely inefficient.
Makes sense. So Pure avoids that.
That's their core advantage. They're all-flash architecture, and specifically their innovative direct flash technology. It's basically engineered to eliminate those storage bottlenecks. For both training the AI models and for running them later, what's called inference. They're essentially building the high-speed data highway that AI needs.
The data highway for AI. I like that. And we saw real proof of this, didn't we? That huge deal with Meta.
Yes, the Meta deal was significant.
Supplying storage for Meta's AI infrastructure, that's not just winning a big customer. That feels like a massive stamp of approval, right?
Yeah.
Validates their tech at the highest scale.
Absolutely. When a hyperscaler like Meta chooses your tech for their core AI build-out, That's a powerful endorsement. It says you can handle the toughest demands.
And it helps them compete against the older players.
Definitely. And beyond just speed, there's their evergreen architecture. This is a big deal for customers. It lets them upgrade their storage systems over time, new controllers, new flash, without disruption. No need for those painful, risky data migrations you used to have.
Well, that's huge.
Mhm.
Lower cost of ownership, less hassle.
Exactly. It lowers the total cost and builds incredible customer loyalty. And they've smartly packaged this into their storage as a service offering, Evergreen one.
Ah, the STaaS model again.
Right. It gives customers that cloud-like pay-as-you-go experience they increasingly want. So you combine the performance, the Evergreen model, the STaaS offering, and you see why they're taking market share from the legacy guys. In a market, by the way, that's projected to hit like $229 billion by 2032, growing over 10% a year, mainly thanks to AI.
Okay, so performance, architecture, business model, it all seems to be clicking. Which brings us to valuation. Pure Storage definitely trades at a premium compared to, say, Dell or HPE in the storage space. So the question is that premium justified? Or is the market getting a bit ahead of itself? Let's unpack that.
It's a fair question, and one investors definitely ask. But I'd argue comparing their valuation directly to Dell or HPE is, well, it's flawed. It's like comparing apples and oranges.
How so?
Because Dell and HPE are mature, relatively low-growth companies overall, even if parts are growing. Pure Storage, on the other hand, has that superior growth profile. Remember, guidance raised to 13% for fiscal 25. Plus, their profitability is expanding rapidly, and they have that fast-growing, high-margin subscription revenue stream up 26% in fiscal 24.
So they look more like a software company.
Exactly. Those are characteristics of a high-quality, high-growth software or platform company. The market isn't just valuing the hardware they sell today, it's valuing their future potential as a key platform in the AI era.
And isn't there a metric, the PEG ratio, that backs this up? I saw a number that looked pretty low.
Yes, the price-earnings-to-growth ratio, or PEG. Based on forecasts of about 17.7% annual EPS growth, their PEG ratio comes out exceptionally low, around 0.45.
0.45. And lower is generally better for PEG, right? Suggests potential undervaluation relative to growth.
Correct. A PEG ratio below 1 often suggests the stock price hasn't fully caught up with the expected earnings growth. So that 0.45 figure is quite compelling, arguing against the idea that are wildly overvalued.
Okay. And what about Wall Street analysts? What's the general feeling there?
Overwhelmingly bullish, actually. If you look at Zacks, their average brokerage recommendation is 1.90. That scale goes from 1 strong buy to 5 strong sell. So 1.90 is firmly in buy territory.
And how many analysts is that based on?
Zacks was tracking 20 firms, and 11 of those rated it a strong buy. Public.com shows a similar picture from 36 analysts, 72% combined, recommending strong buy or buy.
So strong consensus. Any recent changes?
Yes, following the strong Q2 earnings, we saw a wave of price target increases. Needham went up to $85, Raymond James to $88, for example. And it's worth noting, Pure has a really strong track record of beating earnings expectations. For at least 4 quarters straight, they've beaten the consensus estimates, often by a wide margin, anywhere from 7% to sometimes even 100% surprise.
Including the latest quarter.
Including the latest Q2, where they beat by over 10%. That consistency builds confidence.
And does the options market or short interest tell us anything?
They do seem to align with the bullish view. The put-call ratio has been in the 0.46 to 0.49 range recently. A ratio below 1 generally suggests more bullish bets calls than bearish ones puts.
Okay.
And short interest, the percentage of shares borrowed and sold short by bears is quite low, around 3.5% of the float. That means very few investors are making big bets against the stock. Low bearish conviction.
So financials strong, subscriptions growing, profitable, AI relevance clear, valuation arguably justified, analyst bullish, market sentiment positive. Okay, looking ahead then, what's the bigger picture? What are the major trends supporting Pure? And importantly, what could potentially trip them up? What are the risks?
Well, the big picture context remains pretty supportive. We're seeing forecasts for worldwide IT spending looking quite robust for 2025, maybe 8% to 9.3% growth. And crucially, AI is repeatedly called out as a major driver of that spending. Anecdotally, you hear that AI budgets are often ring-fenced, protected, even growing, sometimes by shifting funds from other IT areas. That's a powerful tailwind for companies enabling AI.
A strong tide lifting their boat. Okay, let's talk risks. Even with all this good news, nothing's guaranteed. Where are the potential pitfalls? What should people keep an eye on?
Absolutely essential to consider the risks. No investment thesis is bulletproof. For Pure, I'd highlight a few key areas. One is competitive pricing pressure. The legacy storage vendors aren't just going to roll over. As Pure gains share, incumbents like Dell or NetApp might get more aggressive on price to defend their turf.
Okay, margin pressure potentially. What else?
Second, NAND flash price volatility. Pure is a huge buyer of NAND flash memory. The semiconductor market can swing, and sharp increases in NAND prices could squeeze their gross margins if they can't pass it all on.
Right, dependency on a commodity input.
Third, just the broader macro environment. While IT spending looks resilient now, a really severe global recession could eventually cause even strategic projects to slow down. Less likely, perhaps, but possible.
Can't rule out a major downturn.
And fourth, and maybe most critical day-to-day, is execution risk. Their success relies on continuing to execute flawlessly, especially on these huge complex deals like the Meta one. Delivering for hyperscalers is demanding. Plus, they need to keep innovating rapidly to maintain their technological edge. Any slip-ups there could be costly.
So competition, component costs, macro shocks, and just staying on top of their game operationally. Makes sense. All right, so let's try and wrap this up. The key takeaway for you, our listener, seems to be that Pure Storage isn't just, riding the AI wave. They're actually one of the key companies enabling it. They're helping build the infrastructure for this huge digital and AI transformation. It's a really compelling story, accelerating growth, strong profits, and a strategic spot right in the middle of the AI data boom.
I agree. Our deep dive really points towards a positive outlook. Those buy and outperform ratings, the price targets moving into the 80 dials, they seem, well, pretty well founded based on the evidence, assuming they keep executing and keep digging deeper into that massive AI infrastructure market. The potential seems significant.
So here's a final thought to leave you with. As AI keeps changing, well, everything. Think about the plumbing. What role does data storage, this essential infrastructure, play in unlocking whatever comes next? And how will companies like Pure adapt to the data demands of tomorrow's AI, which will likely be even more intense? What new data challenges do you see coming down the pike as AI gets even more woven into our lives? Lots to think about. Thanks for joining us on the Deep Dive.